So when we decided to do a show about bonds, we knew there was one man and one man only that we could go to, and that man is Steve Broido.
Well, thank you very much for thinking of me.
Of course. Well, I'm excited to hear that this is actually the first time you have been on this side of the glass and sat in the chair and talked on the mic. I know you're not an expert, but we're so happy to have you.
Well, thank you so much, and I'm definitely not an expert, but I am an investor who does do this on his own. So hopefully that's worth something.
Now, how'd you get, so your particular way of investing, not to be like pigeonholing you, but what you're here to talk about today is investing in individual municipal bonds.
Sure, there's a ton of ways to do it. I think we learn a lot from our families and a lot from our parents. I grew up in the 80s, and the 1980s were a terrific time to be investing, especially in municipal bonds and bonds in general. I think my dad tells a story about investing in treasuries that were yielding 11% or something insane.
Wow.
Yeah, not a bad show right there. So growing up during that time, bonds were a pretty cool place to be, and you could earn a fair amount of money then.
And just to be clear, so everyone understands what a municipal bond is. It is a bond issued by a state or local government in most cases. And the benefit is you don't pay federal taxes. And depending on the bond and where you live, you may not pay state taxes. So it could be completely tax-free.
Right. The tax upside is what a lot of investors look for. But if you look at it in terms of a 5% yield, if you look at the taxable equivalent of it, depending on your tax bracket, maybe more like 6 or 7 or 8%.
Right, because you're not paying any taxes. If you earn 6 or 7% on a regular bond, you'd have to first pay taxes and lower that, right?
Right. So tell me a good story, a good love affair that you've had with a municipal bond.
Sure, and I do look at bonds as sort of individual stories. So I used to live in D.C., downtown, and I would drive by the convention center, which they were building at the time.
Which was in the middle of a rough neighborhood, by the way.
Kind of I was transitioning, and lo and behold, much later, there was a bond issued for the convention center. And having seen that thing get built, I was interested. I don't remember exactly what it yields. I think 5.5%, something like that. And I bought some. And it was mostly based on my thought that, I've seen this building go up. I've lived in D.C. for, 20 years almost. And I feel pretty good that this convention center is probably going to be here 20 years from now or 30 years from now. I feel pretty confident about that. I may be wrong. I may lose all my money, but I think D.C. will have a convention center. I saw how big a production it was to build that convention center.
It's several blocks.
Yeah, it's huge. And I know the kind of demand in this area for conventions is pretty high, and that's the place to go.
Right, and that highlights one of the risks of when you're choosing a bond. You have to ask yourself, is the issuer going to still be around when that bond matures to give me my money back?
Right, and hopefully so.
Right, but the good thing is if they are, you know exactly what you are going to get. You have a certain certainty about investing in an individual bond. You know how much interest you're going to get each and every year.
Yep.
And you know how much it's going to be worth at a certain point in the future.
Right, it's predictable income.
Right, as opposed to a bond fund.
Right.
You don't know the income you're going to get, and it does fluctuate in value, which is why some people prefer individual bonds to bond funds.
Right. And with individual bonds, as I understand it, and again, still this is just my experience with it, it's a known entity. So you go in and whatever bond you own will change in value. It may rise or fall in value. And if you're not trading them, you can kind of ignore it and just wait until expiration.
Yeah, I think that's where I get confused with bonds, because bonds in and of themselves it's a pretty simple concept.
It's just a promise.
I'm loaning you $100. You're going to pay me $5 every year for the next 20 years, and then you're going to give me my $100 back, and look at all the $5 I earned along the way.
Exactly.
But then when you start talking about like bond funds and trading bonds, then my head wants to explode. Sure,
and I'm not interested personally in trading bonds. I think you can just get killed that way because what you're betting on is interest rates. And we've talked about interest rates, for years, but interest rates definitely will be moving. That's the one thing I think we can all agree on. They're rising. I don't know what you all got your mortgages at, but I remember getting a mortgage at 5.75% and thinking and hearing, this is the best. It's never going to go lower than this. It did. So interest rates change, and they're going to continue to change. Will they rise? Absolutely. Will they go down? Absolutely. They're going to change over time, and I think that we can all be pretty confident about that.
Right. To Todd's point about why often many people, and maybe even some people at the Fool, will speak about bonds with a certain amount of derision and all that, is because right now interest rates are so low, and they are expected to go up eventually. And when interest rates go up, the prices of existing bonds do go down. If you hold that bond to maturity, it's okay. You'll get that money back. But that is certainly one of the fears people have about being a bond investor these days.
Right. And one of the risks you run, too, is inflation. So if you've got a bond that's paying 2 or 3% and you hold it for 30 years and inflation is 5%, you've actually lost money there. But you have gotten 2 or 3% a year for that. You've gotten the privilege of getting that income for that amount of time.
All right. What about bond ratings? I feel like AAA, triple B, like all that stuff.
That is how ratings agencies will look at a company and assess its ability to stay in business and pay you back your money.
But do munis not have?
They're rated.
They're rated too?
And I mean, it's something that I would encourage everyone to look at. It's part of the story. I don't think it's the entire story. I think people tend to freak out about ratings a little bit too much and say, I'm only willing to buy AAA rated paper, which is great. It's just the yield's going to be a lot lower. And at the end of the day, the DC Convention Center, maybe the rating isn't so great. Maybe it's a triple B, which is still investment grade. It's lower than AAA, but it's still investment grade. What does that mean? Does that mean it's going bankrupt? Does it mean it's going under? Maybe. Unclear. Nobody knows. We'll find out in 30 years. I'm betting that it's not going to go under. That's my bet that I'm making, is that I think it's still going to be around. And just because things aren't AAA doesn't necessarily mean that they're garbage or that they're junk or that they're not worth investing in.
But that does highlight an important point in that just like stocks, if you're going to be an investor in individual bonds, you do have to be diversified.
Very diversified.
Right.
Yeah, you want to be very diversified.
Exactly.
Because if you bet on like Puerto Rico, all the things that are going on there, it's very uncertain. The yields in Puerto Rico are very high right now because there's a good chance Puerto Rico, this story there is not going to end well. No one really knows what that means yet, but there's a lot of municipal debt available in Puerto Rico. It pays a lot, and it pays a lot because there's a lot of uncertainty there and a lot of risk. And if you're willing to take that risk, you will be rewarded for it. But if Puerto Rico goes bankrupt, you may lose all your money. So it's not that different than stocks. I think people freak out a little bit about bonds. Well, will I get all my money back? Well, when we invest in stocks, we kind of think you kind of count on not getting your money back. I think that's part of being a stock investor is I'm willing to lose a certain amount because that's just kind of how it works. I'm going to have some winners, I'm going to have some losers. When you look at bonds, the idea of ever losing any money on anything just freaks people out. And when you really look at it cumulatively, well, maybe one of my bonds fails,
And even in those situations, for most people, if their issuer goes bankrupt, they do get some money back after the bankruptcy proceedings have taken place. Bondholders get money back before stockholders, which is why stockholders usually get nothing.
And the default rate historically it's under 1% for municipal bonds. So yeah, I should count on 1% of them failing. I've yet to have a bond fail on me, but I will. I feel pretty confident I will at some point.
How come whenever we're not in the studio recording and I ask you about ratings, you say, ratings don't mean
I don't know if I'd say, I think I'm channeling my dad. So I learned a lot of this from my dad. And the reason why ratings don't mean frankly, is because Lehman Brothers was AAA rated the day before it went bankrupt, right? So, if there's a hospital in Kentucky, what is Standard & Poor's or what are Moody's? What do these guys know? What do they really know? What if you grew up there and that place has been around for a long time. I don't know. My folks work there. My friends work there. I feel pretty good about that. I went to that college. I feel like it's pretty confident it's going to be around in 20 or 30 years. Maybe I'm wrong. Who knows? It's uncertainty, and uncertainty is really what you will be rewarded for. Is if you're willing to take some risk, and not a huge amount of risk, but the more risk you take, the more your rewards will be.